Would you like to own a slice of one of the best businesses in the world? Want a market-beating yield with double-digit growth? Like the idea of so much demand for a company's products and services that its backlog exceeds its market cap? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a prime defense contractor providing necessary and invaluable defense products and services to entire nations. Human nature introduces human conflict. You can't have humans without conflict, unfortunately. That conflict breeds the need for entire nations to defend themselves from one another. And defense has become much more complicated and expensive over time. We used to use bows and arrows. Now we're manufacturing stealth aircraft. This innate need and natural evolution has turned major defense contractors into money machines, able to produce gobs of growing profit and growing dividends. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Lockheed Martin Corporation, which appear to be trading at a significant discount today. Lockheed Martin Corporation, stock ticker LMT, is the world's largest defense contractor. Founded in 1912, Lockheed Martin is now a $106 billion by market cap global defense juggernaut that employs more than 110,000 people. Fiscal year 2020 revenue is broken out by segment. Aeronautics 40%, rotary and mission systems 25%, space systems 18%, and missiles and fire control 17%. The U.S. Department of Defense accounts for approximately 65% of revenue. International sales account for nearly 25% of revenue. The remaining 10% comes from various U.S. government agencies. Commercial sales are insignificant. Lockheed Martin is truly in a league of their own. Morningstar declares this, and I quote, "We view Lockheed Martin as the highest quality defense prime contractor given its exposure as the prime contractor on the F-35 program and its missile business," unquote. One could quibble with whether or not it truly is the highest quality defense contractor, but there's no doubting its position as the biggest defense contractor. In terms of defense revenue, nobody's even close. Lockheed Martin manufactures a range of major military aircraft, including the F-35 Lightning II, the F-22 Raptor, the F-16 Fighting Falcon, and the SH-60 Seahawk. The F-35, a fifth-generation combat aircraft, is the largest and most expensive military weapon system in the world. In addition, their various missiles offerings are extremely important for both offensive and defensive capabilities. The investment thesis here is quite simple. You only have to believe that human conflict will persist. Since we know that human conflict has existed as long as, well, humans, one doesn't need to do mental gymnastics in order to rationalize a long-term investment in Lockheed Martin. Moreover, that conflict has become more complex and expensive over time and will continue to do so. We used to use bows and arrows, it's now jets and missiles. The future likely involves drones and tech we can't even yet imagine. This kind of progression built onto natural demand bodes well for Lockheed Martin's ability to increase its profit and dividends over the long run. The company has already increased its dividend for 18 consecutive years. Their 10-year dividend growth rate is an impressive 14%. That long-term double-digit dividend growth comes on top of the stock's market-beating yield of 2.8%. This yield, by the way, is 20 basis points higher than the stock's own 5-year average yield. Whereas a lot of stocks are offering up yields right now lower than the recent historical averages, this stock is the opposite. The dividend is also safe, protected by a payout ratio of 42%. I view the sweet spot for dividend growth stock to be a yield of between 2.5% and 3.5% paired with a high single-digit or better dividend growth rate. You can clearly see that this stock is squarely in that sweet spot. Looking at business growth, Lockheed Martin grew its revenue from $46.499 billion in fiscal year 2011 to $65.398 billion in fiscal year 2020. That's a compound annual growth rate of 3.86%. I usually look for a mid-single digit top-line growth rate from a mature business like this. Lockheed Martin is in the neighborhood. Meanwhile, earnings per share increased from $7.81 to $24.30 over this period, which is a compound annual growth rate of 13.44%. very impressive. We now see where that strong dividend growth came from. It came from strong earnings per share growth. A combination of margin expansion and buybacks helped to propel the excess bottom line growth. The outstanding share count is down by about 17% over the last decade. Looking forward, CFRA is forecasting an 8% earnings per share compound annual growth rate for Lockheed Martin over the next 3 years. One of the biggest concerns surrounding Lockheed Martin now, which is a concern that surrounds it at all times, is one of possible Department of Defense spending cuts. Regarding this, CFRA notes this, and I quote, "However, we see this risk mitigated by Lockheed Martin's focus on Department of Defense's high-priority advanced technology programs, which are likely to avoid cuts even if total defense spending is reduced in our view. Moreover, government defense spending has historically increased regardless of recessions, limiting Lockheed Martin's cyclical risk." Unquote. That sums it up nicely. Furthermore, President Biden has already requested an approximate 2% increase to U.S. defense spending. Underpinning that steady growth is the incredible backlog. It's at $147.1 billion as of the first quarter of 2021, which is more than twice the company's annual revenue. It's also greater than the entire market cap of the company. And then there's the $4.4 billion acquisition of Aerojet Rocketdyne Holdings Inc., stock ticker AJRD, which is supposed to close in the second half of this year. This gives Lockheed Martin greater exposure to propulsion and space, which is a growth area for the business. I see CFRA's near-term earnings per share growth forecast as reasonable. Lockheed Martin's own midpoint guidance for this fiscal year's GAAP earnings per share would show a 7.6% year-over-year growth rate, and that's not far off from 8%. With the payout ratio being as low as it is, that would portend similar or better dividend growth for the foreseeable future. Indeed, the most recent dividend increase announced toward the end of 2020 came in at 8.3%. Moving over to the balance sheet, the company maintains a rock-solid financial position. The long-term debt-to-equity ratio at 1.94 is high, largely because of low common equity rather than a large debt load. Their interest coverage ratio of over 15 is great and shows no issues whatsoever with debt servicing. Profitability is robust and improving. Margins have been expanding nicely, although low common equity has juiced return on equity. Over the last 5 years, the firm has averaged annual net margin of 8.93%, and annual return on equity of 308.93%. There really is very little to dislike about this business. It's fundamentally excellent, the backlog is huge, their industry is an oligopoly, and it provides a necessary suite of products and services to very willing buyers with near unlimited checkbooks. And global scale, significant barriers to entry, long-term contracts, technological know-how, and high switching costs provide the company with durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. While competition is naturally limited in this case, regulation is heightened as a result of working directly with government agencies. Their very business model presents a unique geopolitical risk. Production execution has been a recent risk. Cost overruns with the F-35 program are an example of that. Any pressure on government spending, which would put pressure on Department of Defense spending, could reduce Lockheed Martin's revenue and profits. In my opinion, these risks are very manageable, especially when compared to the company's overall quality. And with the valuation being so appealing, this is particularly compelling as a long-term investment right now. The stock is trading hands for a price-to-earnings ratio of 15.1. That's well below the broader market's earnings multiple. It's also way off of the stock's own 5-year average price-to-earnings ratio of 23.1. There's also the price-to-cash flow ratio at 13.7. It's materially lower than its 5-year average of 17.1, and the yield, as noted earlier, is higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. This dividend growth rate is on the high end of what I usually allow for, but I think this business merits it. That's lower than both the demonstrated 10-year earnings per share and dividend growth rates, respectively. It's in line with CFRA's near-term earnings per share growth forecast, and it's slightly lower than the most recent dividend increase. With the underlying business growth further bolstered by a moderate payout ratio, I judge this as a sensible expectation for long-term dividend growth. The dividend discount model analysis gives me a fair value of $561.60. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Lockheed Martin as a 4-star stock with a fair value estimate of $436. CFRA rates Lockheed Martin as a 5-star strong buy with a 12-month target price of $504. I came out on the high end, but we all think the stock is priced below its worth. Averaging the three numbers out gives us a final valuation of $500.53, which would indicate the stock is possibly 34% undervalued. Here's the bottom line, guys. Lockheed Martin Corporation is a high-quality company with a backlog of projects that exceeds the entire market cap of the company, ensuring plenty of revenue, profits, and dividends for years to come. With a market-beating dividend, double-digit dividend growth, a moderate payout ratio, almost 2 straight decades of dividend increases, and the potential that shares are 34% undervalued, this is a dividend growth dream stock. And now for a special news announcement. Microsoft Corporation, stock ticker MSFT, just reported their fiscal year 2021 Q3 results, and just wow. Revenue increased by 19% year over year. GAAP earnings per share increased by 45% year over year. It's an amazing business. And this is why I highlighted this high quality dividend growth stock as an excellent long-term opportunity only weeks ago. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.